Today, Kiwi new mortgage borrowers are stretching themselves less. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, the latest figures from the Reserve Bank of New Zealand just out shows that New Zealand's new mortgage borrowers are stretching themselves much less than in recent years. That's relative to the amount of debt they're taking on relative to their income. Now, this is a mechanical process, of course, partly because of higher interest rates means the borrowing power is reduced and therefore people can borrow less. But the statistics do tell quite an interesting story when you start to look at it. In fact, new mortgage borrowers this year continue to take on very much less debt relative to their incomes, and the new figures from the Reserve Bank of New Zealand shows that overall the debt-to-income ratios for new borrowers in March were the lowest since the Reserve Bank of New Zealand started compiling that information, although of course that's only back to 2017. Interesting, they didn't worry about it before that. They should have. The Reserve Bank of New Zealand said that in March, the monthly share of new mortgage commitments for all borrowers with a debt-to-income ratio of over 5 times, that's debt more than 5 times annual income, was 34.4%. That's down from 38.8% in December. The New Zealand Reserve Bank said that the monthly share of new commitments with a debt-to-income ratio of over 5 is the lowest recorded since the data collection processes began in June 2017. The share has fallen from a recent high of over 60.2% back in November 2021. This reduction will be giving the Reserve Bank of New Zealand some comfort as it looks ahead to the possible introduction of debt-to-income limits early next year. The detailed figures are compiled monthly but released quarterly. What the data has shown in the time the New Zealand Reserve Bank has been producing is that DTIs were quite high in 2017, dropped through 2018, started to rise again in 2019, and became stratospheric through 2021, hitting peak levels in late 2021, when of course interest rates were ultra low and everybody was being encouraged to go buy. Since then, the declines in debt-to-income ratios for new mortgage borrowers have been pretty spectacular. Clearly, a number of factors are prompting this trend. House prices have on average reduced by about 17.5% from their late 21 peaks, so less money needs to be borrowed. Incomes have increased, but mortgage rates have increased enormously too. And this, coupled with more conservative lending policies from the banks, means it's no longer possible for some would-be homeowners to borrow at the sort of elevated DTI ratios previously seen. It'll be interesting to see how the current decline trend in DTIs for new mortgage influences the Reserve Bank of New Zealand's thoughts on possible implementation of the DTI limits. The Reserve Bank has wanted to have a DTI tool in its macroprudential toolkit, which, by the way, includes already the loan-to-value ratio, or LVR limits, and that's been in use since 2016. But the Reserve Bank of New Zealand struggled to secure government support for DTI measures, firstly from the national-led government and then from the current Labour government. This is due to concerns about the potential impact on first home buyers. But having finally received government approval in 2021, the Reserve Bank of New Zealand then began preparatory work and earlier this year released a debt servicing framework which will enable restrictions to be possibly brought in by March 2024 if needed, with the banks therefore getting 12 months to get their systems ready, should they be required. But it's worth noting the Reserve Bank says given the housing market is currently in a downturn, there's no immediate need to implement DTI restrictions. The Reserve Bank does keep a close eye on borrowings that's done on DTIs of over 5. In other words, where the amount borrowed is over 5 times the income of those taking out the mortgage. It's not completely clear what the level of DTIs that the Reserve Bank of New Zealand will be happy with, and the question of what sort of limits might be imposed if a debt servicing framework is introduced have not yet been explicitly addressed. What would be clear, though, is that the Reserve Bank would now be happy that the DTI ratios of new borrowers are tracking down. Now, it is worth noting, of course, that generally high debt-to-income ratios are indeed a problem, and in Australia, we're still seeing some lending at 6 and 7 and even 8 times. So this is a significant issue, of course, in the Australian market. But it is interesting to see how these ratios have come down in New Zealand. I think the critical lever, though, is simply that banks are tightening their underwriting standards because, of course, interest rates are rising, and as rates go up, the borrowing powers of prospective borrowers drop. And from a household perspective, it's quite clear to me that lower debt-to-income ratios are a good thing because it gives you much more of a buffer should, in fact, events like, for example, unemployment or loss of income hours comes through. And whether the Reserve Bank of New Zealand will ultimately bring in debt-to-income ratio controls is an open question. I suspect they'll probably avoid it at the moment. There are other countries around the world where DTIs are in, and they do have some protective effect on the overall market, but don't seem to generally control home price growth, particularly when interest rates are cut. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.